This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Oh, g'day. How you going? Phil Tarrant, host of the Smart Property Investment Show, in the studio over the summer break to bring you all the info around property and property investing. It's funny how often I get feedback over this period of time saying people want us to do this daily. I want to be on holiday, so I don't want to do this daily, but it's at a point in time when a lot of people binge podcasts, doing whatever they're doing, chores around the house or just sitting around with time on their hands. It's a good time to reflect. I keep saying this over this time, but a good time to reflect and recharge and reset for the year ahead. And podcast binging, it's all the rage. So here we are. It's the regular time of the get together to talk about mortgage finance with Eva Loisance from Finni Mortgages. And I've finally cracked that, I reckon. Eva, how you going?
Good. Yeah, almost perfect.
No, almost perfect. And sorry, we can't deliver you a white Christmas. I'm sure. From where you're from in France, do you normally get white Christmases?
No, not often. I probably had one or two in my life there. That's it.
Okay. Yeah. So you're in the sort of not mountain part of France.
No.
Anyway,
near the water. Yeah.
I quite like Paris just before Christmas. It's a nice time of the year to be there. Good vibe, good energy.
Yeah, there's definitely a lot more lights and decorations and that than we see here. So I do miss a little bit of that, but I love the weather here. So
yeah, that's pretty good.
Yeah,
Aussie Christmases are very different, but for all those people tuning into it, and for 'tis the season, and depending when you tune into this, Christmas may have happened or may not have happened. There's a new movie. I watched it the other day on, I think it was on Apple TV around, I think it was called Who's Going to Make the Gravy or How to Make Gravy, which is based on a classic Aussie Christmas song, which you may or may not know, Eva, but they made it's by Paul Kelly. It's a sort of an Aussie Christmas anthem, and they've actually made a movie out of it. So go and watch it. Yes. I highly recommend it. It's pretty cool, but that's not what we're here to talk about, Eva. We're here to talk about mortgages, and what we'd like to do at this time of the year is sort of reflect on the year past and see if that's going to telegraph what's going to happen in the year ahead. And I've just got off a phone call from our government affairs manager here at Momentum, trying to work out when the election is going to be next year. So it's a funny one to call, and the election will determine and dictate in many ways how Australia will progress moving forward. And obviously property is a big part of that. I spent a lot of time yesterday with some senior folk over at the Real Estate Institute of New South Wales, trying to work it all out and a lot of the themes that they're predicting over 2025. And I'll share a bit of that into the months ahead of 2025. But there is certainly a correlation and a connection between political agenda and real estate, and real estate in many ways is a political hot potato. And you're certainly going to see that as we run up into the election and post the election. Many times inside of politics, and you see it even at a local, state or federal level, real estate is and can get weaponized for the purpose of political aims and ambitions. So we sort of spoke about some of these things with the folk over at Real Estate Institute of New South Wales to try and work all this out. But our government affairs manager, we're trying to plan some events in the earlier part of next year, and we're trying to understand when the election is going to be, and we're not too sure, but the mail at the moment is probably March, April. So I would expect an election to be called in the early part of next year, maybe late January or early February. And the rules are, from what I understand, that it needs to be at least a 6-week election cycle. So that's what we're thinking right now. What that and how that aligns with RBA interest rate announcement, who knows? I think there's going to be a lot happening in that latter part of Q1, earlier part of Q2 of 2025. We're going to be talking about it all across smart property investment, particularly with Eva. What does it mean for mortgages and mortgages rates? So that's looking into the future, but looking back into the past, Eva, some of the big trends of 2024 that you've noticed and you've seen from your notice.
Yep, it's been a big year. A lot of changes, a lot of things happening. Yep.
There's a lot of things happening, and we try and map and give some sense to it all. One of the big trends, big themes, the rise of trust lending.
Yes, and I think people will be sick and tired of of hearing about that now on the podcast, but that's definitely been a huge trend. We used to do maybe, a few months, and now it's a few a week we would do. So a lot happening in that space, a lot more lenders doing them. a lot more fees and scrutiny around them as well. So I think we're going to see a lot more next year, but we're also going to see a lot more challenges to get that through next year.
Oh, you reckon trust lending is going to be even more difficult next year, do you?
Yeah. We can see banks were quite happy. And the whole purpose of trust for our investors is to get a positively geared property, to get a letter from the accountant saying, don't worry, the trust looks after itself, so they can keep investing. So that's the whole purpose of it, right? The banks are starting to catch up on that and starting to ask for financials of those trusts, asking a lot more questions around that. And accountants are getting a little bit more wary as well and not willing to sign those letters as easily as we did 12 months ago.
So the headline is there's going to be a lot more scrutiny around trust-based lending.
Yeah, I think so. And banks are starting to up their rates as well for that. There's more fees on some of them.
Yeah.
And it's been for a little while, but it seems like, I guess it was a bit of a niche product that it became so big so quickly that now it's raising red flags.
Yeah, I don't know how happy I am about that, because I don't want it to be, because I've been
Yes.
all my stuff sits in trusts, and it's always been the way. And you know, me as a property investor, I haven't invested in trust for the purpose of a cash flow or a borrowing capacity. I've created trust-based structures for all the other reasons. However, you know, people are trying to accelerate property investment and they reach their serviceability threshold, buying in their own personal names. It's the inverted commas recommended next step for a lot of people, and a lot of buyers agents are recommending this. So it's probably going to change things around a fair bit, I think. And scrutiny is right around this, and you don't want people borrowing beyond their means, but you also don't want to stifle people ambition when it comes to property investing. But you know, scrutiny around trust lending, I take your point.
Yeah, and there's a big difference also between, let's say, your situation where you've had trust for many years. So banks, and you would sort of believe, well, after quite a few years, it's likely going to be positively geared. What we see is people having trust sometimes that don't even have financials. They just bought a property 6 months ago, get the letter from the accountant. Well, it's like, how do you know it's positively geared? You still haven't done tax returns. It hasn't been a full year of running. And actually had a client declined with a lender because he had a few trusts set up in the same year, got those letters from the accountant, and the bank just said, we just don't believe you.
So accountants need to be really careful with this, because it's their professional reputation and efficacy of their ability to practice accounting. If you ask your accountant for something and your accountant says, no, I'm not going to provide that.
Well, they can't provide it.
You can't coerce your accountant to do it. They have
there's no
professional obligation.
Yeah. So it's that one was a bit obviously tricky and pushy. The accountant was, provided the letter, so I have to go with that. But when they ask, well, we need some evidence there, it seems a bit pushy. With no tax return, financials, whatever, that just didn't go through. I think there's still a lot to do there with trust, and it's a great strategy. It's just going to be a little bit more difficult and has to be done right.
Yeah, my recommendation would be make sure you're working with a good accounting practice who actually understands real estate, property investing. If you're going to go down that pathway, it's a lot more complicated investing through a trust. It is more expensive, number one. It's the cost of doing business. But number two, the compliance regime is significantly more. There's a lot more undertakings on behalf of you as a guarantor inside those trusts. It's a lot of benefits investing in trusts. But I've spoken about this with other people on this podcast, Eva, the Smart Property Investment Show, where the trust-based investing should be the exception for property investors rather than the norm.
Yes,
and
that's right.
The reason why is that most Australians only own between one or two properties, and to actually have them sitting inside a trust rather than your personal names, and an accountant will provide you this advice for your financial plan is probably uneconomical and unnecessary, because the cost of doing business of holding properties inside a trust substantially more expensive. You're not getting any of the land tax thresholds. You're not getting any of some of the other
negative
benefits. So be very careful if you choose to invest in trust, and make sure you're doing it for the right reason. Theme number 2, Eva, and I see this all the time: fierce competition amongst SMSF lenders and the popularization also of SMSF as an investment vehicle. I imagine the typical cadence is someone starts a property portfolio out buying stuff in their personal name. And you can listen to it with a podcast I do with my accountant called In the Balance, Munzer Khan, where he says that's where most people should start. Yes, there's versions or variations of it. The next step normally is a self-managed super fund. And then the next step after that is trust-based sort of investing as unit holders and that sort of stuff. So SMSFs is normally when people tap out in serviceability. Typically, the SMSF's the next point and call.
Yep. And we've seen a lot of that. It probably picked up over 2 years ago now. But now the investors have really gone hard with that. The banks are coming with new products, more competitive products, more flexible products all the time. There's even a bank that used to be doing SMSF like 5-10 years ago, coming back to it next year.
Who's that?
Can I say?
Sure. Well, now hang on. What color is the logo?
It's blue.
Is it a Big Four bank?
No.
Who is it?
AMP is coming back.
Okay, all right. Yeah, they've got a fancy new building down in town. I don't know if you've seen it, but okay. Because
a lot of and it's getting easier and easier to get through SMSF lending with very little. When it used to be, I need 250,000, you need 30% deposits, you need a huge amount of liquidity. All that is out of the window. So if someone wants to do it, it's quite easy. Definitely quite easy.
So about a decade ago, maybe a little bit longer, there was a huge push towards getting people to set up self-managed super funds to put property inside of it. And there were some operators out there who were probably less than scrupulous. And it really, I'm not going to say damaged, it really tarnished the property inside a super sector for a little while. And then sort of running in parallel with that, or maybe augmented by that, was a lot of the lenders pulled out of SMSF resi lending, and those lenders that remain really ratcheted up their rates, and it become a lot less attractive. And you're left with only a handful of lenders in that space, and the rates were probably at a 3% premium on usual resi rates outside of SMSF. So it's good to see it's coming back in, because I think it's not a bad outcome or strategy for people to actually use their SMSF in the right way. Again, if they actually understand and have an appreciation for the compliance regime connected with investing inside of SMSF, it requires a lot more robust setup and structure around it, and accountability around it. You're running a fund, and yes, there's help around it with your accountant and auditors and stuff. But I always question why there was such a high premium on SMSF lending, because as long as the property stack up inside of it, it's not a bad vehicle for ensuring to some degree the integrity of the asset and your ability to pay down the debt, because you're receiving the rent, but also the contributions. But
the gap isn't as high as it used to be between normal residential to SMSF. It's still a bit higher, but the fees are less. I guess the competition is there now, so you'd see maybe 0.5, 0.6% higher than your. Yeah, it's not as bad as it used to be. And
it used to be really high. I remember you told me a couple of years ago saying, there's people actually with sharper rates now. And is there any of the big four back in SMSF lending?
No, not yet.
All the sort of non-majors, right? So your Liberties are there, I know that. So AMP's coming back in. That's interesting.
Yeah, so Resimac launched a product not long ago. Pepper did it a year ago. Red Z is quite strong in the space. First Mac, BMM, Granite. There's lots, and obviously competition is good for our clients.
Yeah, competition is great. I like competition in mortgages. That's really good. We're going to go to a break. When I come back, some more themes that's really going to define 2024. Back in a moment. Welcome back, Phil Tarrant from Smart Property Investment, chatting with Eva over at Finni Mortgages, finni.com. You said just before we come on air, you guys are flat stick at the moment, a couple of days before Christmas. Why aren't you on holidays yet? You should be.
We should be. I think there's a lot of investors just trying to squeeze in something before the break. And also people bought properties, I guess, mid to late November that are settling now.
Okay. Yeah. Are people sort of stressed going, I need it done? Or is it just business as usual?
No, it's a bit of both, because the issue is when pre-approval, the last 3 months, when they're expiring, end of December, that's almost a 3 weeks gap that you're losing on your pre-approval. So I think that's pushing buyers, agents and clients to get that in before we have to do it again. Okay.
Well, there you go. Trends for 2024 and how that may indicate or telegraph what's going to happen in 2025. Eva, the 1% refinance buffer. Tell me about that. Why has that
Yeah.
been so important?
Yeah, that's been huge actually. So just for people that might not understand the whole gimmick there, your repayments are assessed at a rate that's 3% higher than the actual rate you will be paying. So let's say you get a 6% on your mortgage, you would be assessed at 9%. Make sure you can make your repayment on 9%. That's super high. Most people don't service on that basis, with the rate going higher and higher in the last year or so. But we've seen some lenders dropping that back to 1% for refinancing. And that saved so much of people that felt like they were in mortgage prison or jail, that couldn't afford what they had, that just were stuck on high interest rates. That was had a huge impact for our clients that had, I guess, portfolios and needed to move from high rates. We've seen lenders actually introducing that for purchases as well. So if you could service on 1%, you could get your next property. So not only that got people out of, I guess, tricky situation, but also allowed people to get more properties.
Okay, so is that if you stayed with the current lender or?
No, refinancing, yep.
No, refinancing.
Yep.
So on the basis that you were a good client, you've never missed anything and you got plenty of serviceability?
There are quite strict conditions where you must be, good credit score, good repayment history. The servicing, obviously, less than normal, because instead of your 3% buffer, you only had 1% applied. So you didn't need to have so much surplus to make it work.
Yeah.
So that really got people out of, I guess, lenders where the rate went really high, couldn't renegotiate, had tricky LVR over 80%, where we could actually move them to those lenders that offered the 1% on sometimes 1% cheaper than they were on.
Wow, that's a big saving.
And I think that actually contributed to, the media always had, everyone's going to start defaulting, we're going to have massive sales happening, blah, blah, blah. A bit of fear projected there. But I think this policy actually avoided a lot of that.
So there's always, APRA, there was a whole bunch of stuff going on about a month or so ago around this question around, is that buffer, 3% buffer relevant?
Sure.
Yeah, relevant in a inverted commas interest rate environment, which is at its peak, right? There's a lot of debate going around it. And APRA's pretty much gone, nah, it's staying. That's fair enough. However, there is still ways and means in which lenders can put some of their own individual policies or parameters around certain products to have some variations within that, considerate of the efficacy of the borrower and their ability to show serviceability, serviceability around it. So it's good to see that. Call it innovation, if you will. Call it sort of shades of grey.
I call it common sense, because if someone has been paying mortgage on 8% and managing it, of course they're going to be fine on 6%.
Yeah.
So why not?
And that's the point, right? So common sense often should prevail.
Yeah.
The only issue we have in mortgage finance is that common sense typically doesn't prevail. There's normally policy and regulation and bureaucrats making up the rules, which they make the rules typically for the outliers rather than most people, right? And rightfully, because not everyone is fiscally responsible themselves, and you need rules to govern it. But the best investors I know are fiscally responsible themselves and take accountability and responsibility for their financial circumstances. So I get the point. And do you think that will remain the 1% buffer moving forward?
Yeah, I think so. And it's also giving those banks so much business, and good business. They're good customers. It's so strict, the running to get that through. So
yeah, okay.
I think that's really good business. Yeah.
And if you want to sort of dial into that, like, you've got to show really clean the history of borrowing money, right? You've got to be a good client.
Yeah, that's right.
Yeah. Okay. Another trend for 2024, Eva, you've told me here, is 1 year's financials adopted by all the majors and spreading many options for self-employed to get through without using a low doc. So 1 year financials now is enough.
Yeah. So, I guess historically you needed 2 years worth of financials. The bank would take the lowest or the average of the two, and you still needed to show a good trend for your business. So that's completely out of the windows. And all lenders and NAB as of last Friday are adopting 1 year, just 1 year financials. So do have a great year, and you can just run with that. That's going to spread, I reckon, next year, and more lenders. Yeah.
So why are they doing that? I guess it's a good thing, and that means, so if you had So it means people may do their financials earlier because lenders are only going to ask for 1 year's financials. So you know what lenders are only going to request 1 year's financials.
Yep. Yeah. And it's been, we always had a few options, but it used to be an exception, and you had to provide reason why we should adopt only 1 year. That could be, the business just, grew so much that year, or things, you had to provide some sort of reason why we shouldn't look at the year before. But now it's just the rules. Like if you just had a really good last year, we just go with that. And
do they get to the 11th hour and go, oh, yeah, we need the year prior?
No, that really is the rule, 1 year.
So all the majors now have that. You only need to provide 1 year financials.
Yep.
I didn't know that.
Yeah. Well, look, it just happens throughout the year, and NAB just came on board last Friday. So that's new, right? It's not, hasn't been, yep.
So NAB used to be 2 years. Now they're just 1 year financials.
Yeah, that's right.
That's a big story. I didn't know.
Yeah.
How come you didn't tell me? How come no one told me about this?
Yeah, I'll just tell you now. And that's making a big difference as well for people that used to run on low doc all the time because they're just playing catch up with their finance because they don't want to pay tax and all those reasons why people sometimes don't have tax return. Now in June, you just go and do a good set of tax return and you just come back to me with that and we can run with that. It doesn't matter what happened before.
So if you had a really good 2024 and not a very good 2023, your 2024s, get them done if you haven't done them already.
Yep. And that's all we need.
And that's all you need.
Yep. Isn't that amazing?
That's a news flash to me.
Yeah, it is. It is really good. Yeah.
Better hurry up and get my accounts done.
Yeah.
That's there's so many ramifications there for
self-employed. It's huge. It really is huge. And not only that, banks have been really relaxing their policies with self-employed. Now you can also get mortgages just with showing your NOA. If your notice of assessment shows enough income, we're not even going to look at your tax return or financials.
Self-employed.
For self-employed, yeah, talking self-employed.
But they don't look at a P&L level. They look at an income level.
Yeah, if you did your tax return and the notice of assessment is enough, that's plenty. If you pay yourself a wage and you can show 6 months salary credit, we're just going to get that salary credit in your account. We get the account statement. We can see the income being paid every month, ongoing, regular. That's all we need.
But for prime or for full doc mortgages.
Yeah, full doc. The full doc is becoming really competitive as well. So self-employed have a lot more options without having to really rely on 2 years worth of tax return.
So I didn't know any of this. If I didn't know this, I imagine a lot of our listeners probably didn't know this as well. So let's look at this at a practical level. If you've left PAYG employment 12 months ago and you've done 1 full year of self-employed work and you've prepared your financials with your account to show profit, you're in a really good position to borrow money.
Yeah, so most banks will still require your ABN to be at least 2 years old.
Yep.
Some of them don't though, so just most of them. But yeah, if you have 1 full year worth of tax return that is good enough to borrow money, that's all you need.
Okay. So you probably need to speak to your accountant to work through this, but that's big. That's big. So NAB just fell in line after, how long have the other lenders been like that for?
It's been quite a few years, but again, it was on an exception basis.
Yeah. So now it's completely it's set in stone as policy.
Yeah. Just like, you send your 2 pay slip, well, you send your 1 year financials if you're self-employed.
Wow.
Yeah.
Is that innovation or is that just they're trying to
There's definitely lending. That's definitely lending opening up, I reckon.
Well, I think that's a clear sign that lending it's a different way of opening up, but the subtleties are in the details, right? And this is when you need to use a mortgage broker, because if you go to the bank, you're not going to know this stuff, or you're going to get whatever that one bank's policy is, and they might not even provide or lender. So this is a clear tell of why, if you're not using a mortgage broker, you should be using a mortgage broker. And I do note the numbers just come out from the Mortgage Finance Association Australia a week or so ago, and brokers now represent 75%, rounded up, 74 point something, 75% of market share. So, this is, so you guys know this, you guys are encyclopedias of knowledge around this. So you'd be able to, so someone comes, you go, I've got 1 year's financial, you go, no worries, I know these lenders do it. Bam, you sort it out.
Yeah.
And there's not a rate disparity on 1 year or 2 year financials?
No, that we're talking full doc, normal application. Yep.
Okay.
Just believe it.
Okay. All right. Well, yeah, I'm gonna
It's
look into this.
there.
That's
It's
good to
there.
know. We need to speak more often. It's really good. That's really well
Mm.
observed, Eva, and I'm happy I can chat about that. Point number 5, more scrutiny for investors with over 4 properties. Hence the reason why probably back to point number 1 around
Trust,
trust-based
yeah.
lending.
Yep.
Where's the scrutiny coming from and why?
So we've seen lenders asking for full tax return if you had more than 4 properties, and that is to see the actual expenses on each property and how much maintenance and repairs and all that. And that can really mess up an application when someone declare, I don't know, $500 a month for a property expenses, and then we look at the tax return, and well, actually, there's been some strata issues and one-off expenses, or the rates are higher than declared, and these sort of things. So sometimes with applications that are a bit tight, looking at the tax return really would jeopardize the viability of it, and a lot of lenders are starting to ask for it. Which can be really tricky when clients have a few properties, because some of them.
If you're PAYG or self-employed,
all of it.
But don't they? You got to provide it anyway, right?
No, if you're like an employee, you provide your payslip and your payment summary, and that's it, and declare your expenses.
Okay,
without
this when you can show I'm not a mortgage broker. So if I'm PAYG, you go, I need your pay slips. You go, here's pay slips, and then what you do a HEM type calculation. But if you've got more than 4 properties, they go, hang on a second. I reckon you might not be telling me the full story here.
Yeah.
But inside your tax return, it itemizes every property anyway, saying this is a depreciation, income, expenses, blah, blah, blah.
Yeah. And so just to give you an idea, most people would declare $300 to $400 per property per month. Most people, that's what they would declare. The reality is it's almost double. And if we put that in, it just doesn't work anymore.
But you're only cheating yourself if you do that. You've got to tell the full story.
Yeah, correct. But some people, they just want the next property and will just minimize what can be minimized if we don't have any means to check.
Yeah.
Well, and so banks are asking for it now.
Well, that's certainly and this is a little more of an attitudinal thing. People trying to redline and maybe invest beyond their means. And what I'm hearing anecdotally now is that there's a lot of people, whether there's any merit to this comment, but there's a lot of people now who are probably hitting that wall of going, well, I've got to start, maybe I have overextended and I've got to start selling off some investment properties. It is happening. And maybe, if you cheat yourself, you're going to find yourself in a position where you may need to sell your investment properties. So invest within your means would be my hot tip. Sort of connected with this is point 6, Eva, as we reflect on 2024, tax cut and HEM changes. So HEM is the household something expense measures.
Yeah, that's
so essentially a catch-all where they go, based on looking at thousands of people, hundreds of thousands of people, we reckon that your household costs are X based on what you earn and the makeup of your household.
Yeah. So I remember having a conversation with you last year when the tax cut, actually this year, when the tax cut happened in July, thinking, okay, that's awesome. We're going to have more borrowing capacity coming forward. But I was also telling you, well, the banks are probably going to change how much the HEMS is based on the income. And that definitely did happen. So we didn't really see any change into the borrowing capacity based on tax cut. Didn't happen. But what we've seen is banks actually adjusting what is part of, I guess, what's inside of HEMS, as they call it, or outside of HEMS, which is your discretionary expenses. And some lenders, which is still amazing, would have your investment expenses as your HEMS. So let's say for a couple, based on the income, the HEM is $5,000 a month, they would include maybe the $1,500 they spend on their investment property within that $5,000. Some banks would do, okay, it's still $5,000 plus your $1,500 on top, which changes dramatically how much you can get with one bank or the other if your expenses are $5,000 or $6,500. And we've seen banks changing a few things around private health cover. Is it in or out? And that makes a big difference when it's a family. Often it's like $500-$600 a month. We've seen that with body corporate strata, which can be, quite a few hundred a month as well. And that's sometimes enough to make a deal passed or failed.
And this goes to the point around each credit team and every lender is different. They have different rules
very different.
and policies that govern them. Yeah.
Makes a big difference. And the big one is people that are living at home with their parents. Most banks would still include $650 a month, which again, it doesn't seem like much, but if you're a single income earner on the average income, that can be a big difference into your borrowing capacity. Some lenders now would just say, okay, well, you know what, it's zero. You live with your parents, you're actually not paying anything.
Again, this is when a broker is worth their weight in gold because they know all these things. It is a real capability that brokers have. Eva, we're going to go another break. When we come back, 3 more points to round out the year. We'll be back in a moment. Welcome back, Phil Tarrant, Smart Property Investments with Eva at Finni Mortgages, finni.com.au. I'm going to do some lending in the new year, Eva, so stand by. I keep threatening I'm going to do this, but I'm getting set to go again. So watch this space. So I will be in touch with your team, and I know they'll moan when I give them a call. And I'm probably reflective of some other borrowers and investors, maybe not all, but I do appreciate your team's patience with me as I try and sort out my mortgage finance. Now, point number 7, interest rates dropping outside the RBA decision, low fixed rates may be worthwhile for over 80% and owner occupied. So this is, again, how lenders can play around with rates to try and attract certain types of business, and they'll be hedging against interest rate decisions as well. So offering fixed rate options now before they start coming down, and some people will lock it in and blah, blah, blah. Is there going to be a trend moving into 2025?
Yeah, look, we've seen in the last 6 months, rates, advertised rate, and the rates we actually can get. There's competition there between lenders.
Yeah.
And there is a space where when investors or even owner-occupier would borrow money over 80%, so at 90, 95 sometimes for owner-occ, the variable rate is so high. You pay such a premium on variable that sometimes the rate can be 2 to 3% lower on fixed.
Okay.
Right. So sometimes, yes, you're locking yourself in, but because you're on a high LVR, you can't really refinance outside of that anywhere or pay LMI again. Mm-hmm. There is a space that can be quite interesting, where we get rates on the 6%, where you would be close to 8% otherwise if you get on OC at 98% or something like that. So there's a space there for fixing if you're in that category of clients. And also we've seen banks dropping the variable rates 0.2, 0.3%, completely outside of what the RBA is doing. So,
would you recommend fixing at the moment? Again, this is not advice, and everyone's different, and disclaimer, etc. What's your view on fixing in this market?
No, I wouldn't fix now. The fixed rates are probably just 0.4 to 0.5% lower than your basic, or even package variable rate. So for, I guess, the average client, I don't think it's worth it. But again, if you are over 80% or specific situation of investing, then that can be a good way around it.
Okay. As we look at themes for 2024 and how may telegraph 2025, and I only learned about this probably 3 weeks ago, 95% no LMI in no risk suburbs. So this is essentially a refinancing play, right? So
refinance all purchases.
Okay.
So that's a big thing. I think we should talk about that more probably next year when people start to buy again. You can, it's only one bank, but you can borrow up to 95% of the property price. So imagine the LMI you would be paying on that. So it's only for low risk suburbs. So we're talking, Mosman, Bondi, Paddington, those premium suburbs. You would need a loan of at least 2 million. So it's also, but I guess 2 million
it has to be at least 2 million. So it's got to be a big loan.
Big loan, but I guess, if you buy something in Bondi, you're not going to get a 500K loan, I wouldn't say.
No, true.
So that would save, let's say someone that gets a $2 million loan in Bondi at 95%, you'd save probably $60,000, $70,000 in lender's mortgage insurance, which is, it's a lot. And it's a cost that, yes, it's lender's mortgage insurance, it's not protecting anybody but the lender.
Do you need to refinance in order to get this? So is it with?
No, purchases or refinance.
Okay, so if you're with the current lender that offers this, you'll need to do a refinance with that lender in order to extract the equity out on that basis. So say, for example, I've got a $4 million house and I want to pull $2 million out of it to refinance, I need to do a whole new application with that lender in order
Yes,
to
correct.
do that.
It's a whole new thing. Yeah, yeah.
Yeah. Okay.
But yeah,
Wow,
it's worth looking at.
So it's not a second mortgage; it's a whole new mortgage.
It's a whole new mortgage. It's also just a bit like the 1% buffer has to be very clean clients, high net worth. They would really look at your, I guess, profile in terms of how much assets do you have, your credit history. It's almost like a internal score the bank will give if that client is worthwhile or not getting that LMI waived.
Banks love getting high net worth people who can pay back debt into more debt. They love it.
They love it.
Absolutely love it. And are the majors doing this?
Yeah, it's one of the major. Yeah.
Who?
NZ.
Ah, that's right. I think I know that. That's cool. I sort of get it, right? Like, and do you think they'll hold that policy as interest rates come down?
Yeah, I think so. The interest rate there's no difference there.
Yeah.
But I think again, it's attracting your very good clients, which actually are low risk and don't really need to pay LMI. Like it's
is it inside ANZ? Is it ANZ Wealth private or is it just a normal?
Just a normal, just a normal, So that is,
it's cool. I get the application of that, and I would say if interest rates start coming down, so therefore it's cheaper to hold debt. You probably see some people refinancing out and buying in places where they think they're going to get good growth plays on the assumption that they can service the cash flow impact of maybe if it could be your principal place of residence. I imagine a lot of time it'll be people refinancing their principal place of residence. But you do that refinancing your principal place of residence, that bit, if you're using that for the purpose of investment properties, that becomes tax deductible, correct?
Yeah, if you're using, yes, correct.
Yeah. So some people might even use that as ability to get a hybrid negative gearing type situation or getting some tax effective debt against their principal place residence. Again, you're going to have to speak to your accountant. It's way beyond my pay grade, but smart accountants will be able to work this out. So it probably is in your favor on the assumption that you're deploying that money into good growth assets. So again, it's quite a complicated and strategic thing to do. So make sure you get the right advice around it. I'm going to say 2 more points to round this out to 10 points, Eva. The first point I would say about trends for 2024 and how it looked in 2025 was that extension of interest-only periods from 10 to 15 years. CBA did that. And also you don't need to do a full application anymore to extend your interest-only period. I reckon you're going to see more of that.
That would be great. That would be so good if we don't need to do application. It's just such a waste of time for us, for the bank, for the client. So can't wait to see more of that, more lenders following through.
Yeah, and again, probably 10 points here, and I know our team will like a nice sort of round list. It's going to be directly connected with the property investors' attitude to continue investing into 2025, considering they sometimes feel like the punching bag for state governments for raising their state treasuries, because property investors and property owners in general seem to be an easy target for increasing tax receipts for state governments, whether it's land tax changes, whether it's stamp duty changes. And I'm even seeing at a local level here where we're recording in North Sydney in New South Wales, they call it consultation, but I think it's a fait accompli. The North Sydney Council is looking potentially to increase rates locally by 100% in order to fill their coffers. And again, that's a tax on property holders, whether they're owner occupied or investors. So things like this, the decisions made to balance the books inside of state governments or local governments will change the makeup of investors who are operating in those areas or those states. And you see it happening in Victoria absolutely at the moment. Changes made by the government around taxation is really affecting the trajectory of the property markets there. So that will be a trend that absolutely continues. And you can only take for so long from property investors and property owners before you're seismically going to change the nature and the makeup of markets to the detriment of, I would say, Australian renters. And you're seeing that taking place right now. I can't remember exactly the number, but there is a huge amount of investment properties or rental accommodation have been taken out of the Victorian market as a result of the state government there making changes to how they tax property investors. And one side of the community is going to say, isn't that great? That means we now have more homes available for first-home buyers. fair enough. The other side of that is the stress around rentals is already pretty considerable. So you take more rental stock out of the market. That means rental markets are tighter. It's going to be harder to rent. Rents will go up and some people are not going to be able to find some houses. Now, that's a horrible situation. Yes, in an altruistic sense, wouldn't it be lovely if every single Australian could own their own home? It's not the reality for all Australians because that's just the very nature of it. A third of Australians rent. It's probably going to stay like that. So you need to make sure there's rental accommodation for them. So don't manipulate markets too much. State governments would be my message on the basis of trying to extract more money out of property owners and property investors in Australia. So that's the 10th theme for 2024, which we've seen, and it's going to continue to play out certainly over 2025. And I'm going to be looking at this right across the Smart Property Investment Show and bringing some people in who are right at the pointy end of this in trying to shape the attitudes of state governments and federal legislators around it all. That's it for us, Eva. Good 2024. Thank you.
Yeah, that's good. All right.
I do enjoy it. I've learned a lot from you today, so thank you. Keep up the good work over at Finni. If you're tuning in this, you guys are actually can you still contact you guys over the break? Is that all right? Like someone?
No, we're shutting down on last day is Friday, coming back on the 6th.
Okay.
So no mortgages. No mortgages on Christmas Day.
Can you go online and still book a time in?
Yeah, that's
after
right.
The 6th? Yeah. Okay.
Yeah, that's still open. Our calendars are open. So if anyone wants to get in 6th of Jan, that's open. Yep.
And so to be prepared for that, say I tune in this podcast and go, yeah, I'm going to do something about this. And this is my year, 2025. I'm going to go nuts and blah, 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 blah. Or, I'm using a lot of blah, blah, blahs today. I don't normally use that. Or, hey, I need to do some of my mortgage. They're not right. Or I think I'm overpaying. So you can go in over the break and you can choose a time now for after the 6th to actually speak to someone. So you can actually put that peg in the sand and take action. What's the best way to be prepared to have a good conversation with you and your team, Eva?
I think to have numbers in terms of your property value, your property mortgage, your rental income, and your actual, I guess, business income. If you're self-employed, you wouldn't believe still how many people give me their turnover as their income.
Yeah.
Which makes
rather than a profit.
Yeah, which make a bit of a difference in in the assessment. So I guess, and also people just don't know how much they earn. So have a look at your tax return. Just look at the net profit, and once you know your number, it's a good start.
Yeah. Okay. Good work. Well, thanks to you, and pass on my appreciation to your team over at Finni Mortgages. Some of them who have come on this podcast, and we've sort of introduced them out over 2024. I do enjoy getting together with them, and if only a handful of points there just indicate the need of using a mortgage broker if you're serious about investing in property, or you want to make sure you got the sharpest home loan. Or the most relevant home loan for you as an owner-occupier, get into it. That's Eva over at Finni Mortgages, finni.com.au. Get in touch with them. Do yourself a favour. If you want to take action, 90% of winning is beginning. To put a time in their calendar for some time in January when they're back in the office and say, this is my year, I'm going to get going, and it's best to get going early in Jan 2025. Remember to check out smartpropertyinvestment.com.au. There's a whole bunch of other podcasts you can tune into if you want to binge over the holiday break. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Feeling trapped by rising interest payments? Escape from mortgage prison with expert refinancing assistance from Finni. We have helped hundreds of borrowers break free from higher loan repayments by finding a more suitable loan. Our expert team can quickly assess your situation, and if there's a better lender available, we'll find it fast. Don't delay. Call today. Speak to a Finni mortgage specialist on 02 8866 2444 or visit our website at www.finni.com.au.